Well, David and Anka, thanks for having me, and thanks for all the follow-up leading up to this. I know I'm not the easiest person to get a hold of sometimes. A lot of balls in the air, so to speak, but I'm glad to be here and glad to talk options with your audience. And it's I'm glad that I'm following the presentation that just preceded me. I caught the last 10 or so minutes of that presentation, and glad to hear them talking about trading psychology. I think, and I'm no trading psychologist, and I'm not going to offer anything insightful or new or earth-shattering on that front. But a big reason why I got attracted to options trading was, in a way, it was a way to address my own trading psychological shortcomings, so to speak. I've been trading since 1998, and I proved to myself time and time again that sometimes I'm not the best at picking direction, and sometimes I'm not the best at honoring my stops, and sometimes I'm not the best at being patient. And I found when I started trading options, 5 or 6 or 7 years into my career, that I could use options to really address many of my shortcomings as a trader. So with that setup here, I'm going to get into my presentation, but for some reason I can't switch my slide. What's going on here? Let's go. Let's move forward. There we go. Okay. There we go. So as always, we have to throw disclaimers up. I'm sure this won't be the last disclaimer you see today, but basically the nutshell is nothing you hear or see here should be considered financial advice, yada, yada, yada. Anyway, all right, we'll move on. So the topic of my presentation here is going to be using volatility to inform strategy selection so that we can leverage the odds in our favor. Now, little warning to everybody going into this. I am not a, a PowerPoint wizard. So if you're expecting fancy slides here in this presentation, I'm sad to disappoint you. I am not a slides wizard. I'm just focusing on getting the points across. So I just want to throw that out there ahead of time. But this is what we're going to talk about. What we're going to lead up to is using volatility to inform trading selection, because I think volatility is something, especially amateur options traders, and I was guilty of this absolutely for the first few years of options trading myself. Volatility is one of the things that's often overlooked for traders when they're considering putting on positions. Even if you're just, a real basic options trader where you're just buying straight calls or straight puts to be bullish or bearish, even then, volatility offers some very important clues to help you get into the best trades possible. All right, so who am I? Well, that's me. That's a picture of me. My wife took one day. She surprised me, whipped out her camera while we were on a hike, and said, "Hey, this stick, this branch, tree that's fallen looks good. Will you sit on it?" And so that's me. I live in Colorado, as I mentioned before, and that's just us on a hike somewhere in Colorado last year. So who am I? Well, I mentioned before that I began trading in 1998, and I was engaged in day trading NASDAQ stocks, essentially. For those of you who weren't around trading at that time, but you were probably aware that in the late 90s, the NASDAQ.com boom was in full blossom, and it was quite a wild ride to be a trader. And while we've seen some interesting times this year, and we've seen interesting times during the financial crisis, and during the flash crash and things like that, these are all very interesting times, but nothing for my money can quite compare to the type of trading that we had in the late 90s and early 2000s, when the tech boom really took off and then blew up. It was just crazy trading. It was a crazy environment to learn how to trade. And I was actively engaged in day trading stocks, like I said, NASDAQ stocks, and we were just high volume. I was doing hundreds of thousands of shares a day eventually, not right off the bat, but in short order within 6 months or so, hundreds of thousands of shares a day trading. And it was really a trial by fire. I worked in an office with 40 other traders. All of us were in our 20s and none of us had any Wall Street background at all. It was a time where we were all just really teaching each other. It was something else. Well, next, after trading stocks, I did that hard focused from 98 till about 2002. And then in 2002, I had gotten really involved, really interested in not day trading, in trading futures and commodities. I did a lot of research. I'm a voracious reader. I've read probably every trading book out there. But one story in particular that caught my attention was the story of the turtle traders. And I'm not going to get into the whole turtle traders here, but if you Google turtle traders, you'll come across the story of the turtle traders that were trading commodities in the 80s. Anyway, that story was really inspiring to me, and it inspired me to explore trading futures. And eventually, I put a lot of effort into it. I created a strategy and eventually launched a small fund where I had just a handful of investors, not a big fund by any means, but it was a handful of investors, and I managed money starting in 2002, which eventually led to me becoming a member of the Chicago Board of Trade. I moved to Chicago in 2003, became a member of the Chicago Board of Trade, had an office upstairs at the Board of Trade. I was never a floor trader, but I did engage with floor traders often, for sure. And that was a fun time, I'll tell you, man. Being around those types of traders in that environment was something else. But it was really around 2006 where I really started focusing on options trading. Now, I had traded options throughout from the beginning when I started in 1998, but really they were just kind of like, speculative bets, and I didn't know what the hell I was doing. It was really just, throwing things up in the air and see what would stick. But it was never like a focused endeavor. It wasn't until about 2006 where, after I closed down my my commodities hedge fund, options really, like I mentioned before, it appealed to me because I loved the idea that I could use strategies to address some of my shortcomings as a trader. All right, for some reason this my slide deck keeps hanging for some reason. All right, anyway, so fast forward, while I've always been trading, and I haven't stopped trading since 1998. I've done other things in between, which is the nice thing about trading and the career paths I've chosen. I've worked for companies that are deeply involved in the stock market, so it all kind of seamlessly works together. And so from 2010 through 2017, I served as a director of community at StockTwits. I don't know, I'm sure many of you know what StockTwits is. StockTwits is basically the financial version of Twitter. And I was pretty heavily involved in building that community and building it from next to nothing into the audience that it has now. And my job was, we all wore many hats there, but my main job was keeping our community informed of what was going on in the market, educating users on best practices, and working with our partners and financial partners to get the most out of their engagement with StockTwits. And starting in 2017, after I left StockTwits, I moved on to Trade Ideas LLC, where I am currently employed. I do sales and trader education at Trade Ideas. Trade Ideas is a great software platform for active stock traders. It can be great for options traders as well. For those of you who are directional options traders, Trade Ideas is great for finding stocks that are on the move based upon your criteria and whatever you deem to be important to you. Trade Idea software is fantastic for that, and I serve that. I serve to them. I serve for them to this day. And I also, starting in 2018, I serve as the chief option strategist at All Star Charts. All Star Charts, for those of you who don't know, is a technical analysis-driven research firm where we publish research for our subscribers that is covers the world, really. I mean, we don't just focus on U.S. markets. We cover all markets around the globe, and we do kind of a top-down approach, analyzing data from a technical point of view, not a fundamental point of view, from a technical point of view. My job at All Star Charts is to take ideas that come from the strategy team at All Star Charts and show people how to express that trade idea using options. And that's what we're going to talk about here in this presentation. Wow, so this is weird slides. I don't know why it's doing this, but whatever, we'll get through it. So why do I prefer options trading? Well, the big reason is it gives me the ability to design bullish or bearish or neutral trades for whatever type of market environment we're in. I mean, and we've been in quite a market environment this year, right? Since end of February is when the market really just, completely changed character. And option strategies that were working, through the last half of 2019, well, those strategies didn't work at all once we got into February, but that doesn't mean we're out of luck. Options give us options. It's kind of a cheeky phrase to say, but it really does. Options give us options so that if we're bullish, we can express bullish trades. If we're bearish, we can express bearish trades. If it's a volatile market, we could put trades on that benefit from high volatility. We could put trades on that benefit from low volatility. Okay, maybe I just need to click my button on my mouse. Okay, so another thing that I love about options is margin efficiency. And what I mean by that is it doesn't require as much capital to put on an options trade. For example, if you're, let's say you're bullish on Apple, okay? Well, if you're a stock trader, the stock's trading at around $318 right now. If you were to buy 100 shares of Apple, that's going to set you back. That's going to set your account back, what was it, $30,000? Now, if you have a margin account, it's not going to require as much money, but it's still going to require a good amount of cash. We're talking many, many thousands of dollars just to hold that Apple position and to maintain that Apple position. Well, and I'll talk in the most basic terms here. If I were to express a bullish Apple position, instead of buying stock, I buy a call option instead. Well, a call option might only cost me a few $100. Okay, so I could buy, the stock's trading right now around 317. I could buy 100 shares of Apple at 317. It's going to tie up, $30,000, right? Or I could buy a slightly out of the money call, let's say a 320 call that expires in August, and spend, I don't have the prices in front of me, but let's say it costs $600. That's it. All I need in my account is $600 to control the same amount of stock. One options contract controls 100 shares of stock. So if Apple were to explode higher, I could participate in that same move using options and tying up far less capital. That is important. And the next part of that is leverage, right? That same move in Apple, let's say Apple goes from, let's say it has a 10% move. It goes from 315, let's say, and it goes up to 340, 345. That's about a 10% move. I'm ballparking. Well, if you bought the stock, you're up 10%. Wonderful. That's a great return. Okay. Well, if I bought that, let's say that 320 call, and and I paid, let's just keep the number simple. Let's say I bought it for $500. No, let's even simpler. Let's say I bought it for $1,000. That's probably too much, but say about that 320 call for $1,000 and Apple moves up to 345, well now that same call that I spent $1,000 on is going to be worth 2,500. That's what's that? That's 150% return on the same move. So leverage is important. Now, leverage is a double-edged sword. You have to be careful with leverage. If things don't go your way and you have naked exposure, the other side of leverage can be very painful, but we'll try to avoid that. And maybe the last thing, the biggest thing, and why I prefer options trading is the ability to precisely define risk. Now, I mentioned that earlier on, options were appealing to me because it helped me address many of my shortcomings as a trader. And one of those shortcomings was honoring stop losses when a trade goes south, when a thesis is busted. You know, I mean, we've all been there, right? If you've been trading for any length of time, you've been there where you've put a position on that you feel like you've thoroughly researched, you feel like all the stars are aligning. This is the trade that's going to make your day, your week, your month, your year, whatever it is. You're just not only fully invested with your capital, but you're fully invested emotionally. And again, this is why I liked following the presentation that preceded me, is that we were talking about trading psychology. Trading psychology is so huge. And so when you're fully invested both financially and mentally in a trade and it doesn't work out and the quote unquote unforeseen happens, which of course nothing should be considered unforeseen in the markets, anything is possible. But when the trade goes south and all of a sudden you're at your level where it's time to pull the trigger and get out, this thing isn't working. I know you put a lot of effort into it, but it just ain't working. I know me, sometimes I hesitated like a deer in the headlights, and I was afraid to pull the trigger and afraid to get out because I didn't want to give up my position. What if this thing comes back? Well, I could tell you that 9 times out of 10, that thinking just ended up costing me more money. And in some cases, drastically more money. So with options trading, I found that I was able to protect myself from myself, so to speak, where I could put trades on and different strategies that had defined risk. So I knew going in that if the trade doesn't work, no matter what, the most I can lose is X, whatever that number is. And I'm comfortable with that number. And that's an important point to put out, is you have to be comfortable with it, right? It can't just be a number and be like, oh, well, I hope that doesn't get hit. No. You have to define your risk up front, and you can do that with options. And going back to that Apple example, talking about buying a 320 strike for, let's say it cost me $1,000. I know going in that if Apple doesn't move and if that option expires worthless, the most I can lose is the $1,000 I paid on that trade, nothing more. Apple can go to zero tomorrow. Of course, that won't happen, but Apple could go to zero tomorrow. The most I will lose is the $1,000 I put to risk in that trade. So those are some of the biggest reasons why I like options trading. So again, I apologize. My slides are very amateurish, lots of words, very little pictures. I apologize. That's just the way it is sometimes. So how do I pick my trades? And this is important. And we're not going to get into a deep dive here of how to arrive at an opinion on a stock, how to be, where you want to be bullish and where you want to be bearish. That's not the goal of this presentation. My presentation is just to show you that options give you options. Okay, there's a bunch of options presenters happening later in the day today. I'm sure we'll get into some more details, and that's great. I just want to kind of lay the groundwork here, set the stage, maybe whet your appetite for options trading. If I can do that, then I feel like I've done my job. So I'm not going to sit here and tell you that technical analysis is the best way to get your trading opinions, or fundamental analysis is the only way to go, right? All that matters is that as a trader, you want to have an opinion. or you have an opinion, however you arrived at that opinion. So the first step in putting a trade on is you have to have an opinion. Are you bullish? Do you think the stock's going down? Do you think the stock's going up? Do you think the stock is going to go sideways? Okay. I mean, at the end of the day, a stock can only do one of 5 things. Stock can go way higher. Stock can go moderately higher. Stock can go sideways. Stock can go slightly down, or stock can go way down. Those are your 5 scenarios in any time frame, right? So you have to decide which of those scenarios you think makes the most sense. And then once you've arrived at that, once you've decided on that, then we could use option strategies to take advantage of any situation. But implied volatility is the X factor, okay? I mentioned at the top of this presentation that implied volatility is one of those things I feel like is very overlooked, especially among newer traders. Maybe not so much for professional option traders who've been in this game a long time. They've learned the hard way that you can't ignore implied volatility. Implied volatility is so important to the trade selection, okay? So I've got a graph here that you can see on my screen. This is just, a 1-year chart of implied volatility. Now, you'll see a number here, a score. And I just pulled this off of any chart. I don't even remember what chart it was. It doesn't matter. But at the end of the day, I don't care about this number here, this 0.2469. I don't care about that number. It's going to be different for every stock. What I do care about is where is volatility today compared to where it's been. That's really all I care about. Now, I don't know what kind of trading platforms you use. I use both Thinkorswim and I use Tastyworks. I do most of my trading on Tastyworks, but I still keep Thinkorswim around because I love their analysis tools. And I love this volatility chart that you're seeing right here. I could put this at the bottom of any chart that I pull up in Thinkorswim, and it allows me to get a really good visual of where implied volatility has been. Now, let's get into what is implied volatility. Implied volatility is one of those terms, certainly was for me, it's one of those scary terms, right? There's a lot of math involved. This is where when people start, kicking the tires of options trading, this is where people start getting scared. Okay, what is implied volatility? At the end of the day, there is a lot of math here, and I'm not going to get into the math. I don't think the math is important. But basically what volatility is telling you is it's telling you what are market makers and market participants pricing in as it relates to fear. When market participants are scared, and they could be scared for any number of reasons. They could be scared because they think a stock is at risk of collapsing. We certainly saw options volatility getting raised across the board earlier this year, February and March, right? As the market was selling off, options volatility went higher across the board in every name. Why? Because market participants were scared. And what do they do when they're scared? They hedge their positions. And how do they do that with options? Well, in many cases, they just buy puts. And if you got a lot of people trying to buy puts all at the same time, right, it's supply and demand. The price of puts goes up. And options volatility, the implied volatility, reflects the pricing of those options. So when people are scared, volatility goes up. Now, maybe let's go the other way. Maybe they're not scared, but let's say we're going into an earnings event. Maybe people aren't scared, but they're being opportunistic, right? People are thinking, ooh, I think the stock may have a big move higher coming out of earnings. Okay, well, in the same situation, if you got people expecting that there's a good chance that the stock's going to announce big earnings or maybe a big product announcement coming up, people are going to bid up the cost of calls. Buying calls is a bullish trade. So people are going to start bidding up the price of calls, and that will be reflected in the implied volatility score. So all implied volatility is really telling you is there supply and demand for the options, okay? When demand is high, prices go up, the implied volatility score goes higher. When demand is low, typically people are not too scared, people are not thinking there's any big move on the horizon, then volatility will be low. And it's important to know all this because really all we care about is where volatility has been in the past, because volatility tends to mean revert. What do I mean by that? Well, when volatility is high, and in many cases it's because fear is high, fear recedes, fear ends. People either the scary thing passes, and people are no longer scared, or the scary thing remains, but people get more comfortable with the risk and they're no longer afraid of it, right? I mean, we're humans. At the end of the day, we're all humans, and we all learn to adapt. We're all doing that right now, right? I mean, our whole lives have changed in the last month or so as we've all gotten used to wearing masks in public and staying away from our friends and social distancing and all that. That was all very scary 6 weeks ago, 2 months ago, but now, we're starting to get into the rhythm of it. We're starting to understand it. We don't like it, but it doesn't really scare us anymore. Okay, so the fear has subsided, and volatility does that. Volatility is a reflection of human emotion, right? And so volatility is mean reverting, and so that is very important to note as we're considering putting trades out. Generally, and this is, these are general expressions. There's no rule, little sidebar, there's no rule in options trading or any trading. There's no rule that works every time, okay? Rules are good to have. Rules are good to keep you on point, keep you focused, but they don't work every time, right? If rules worked every time, we'd all be rich, because all we would do is just follow the rules and we'd all be rich, right? But that said, generally speaking, when volatility is low and options prices are low, I generally want to be a buyer of options. So whether I'm bullish or bearish, I want to put trades on that are debits, cost me money. So in its simplest terms, if I'm bullish, I want to be a buyer of a call. And if I'm bearish, I want to be a buyer of a put. That's it. Because premiums are cheap, relatively speaking. Okay? And so if we get a move, hopefully I'll benefit from the direction of that move with the long call or the long put. But, and this is especially important in the case of buying a put, if the stock were to roll over and start going down, not only would the put benefit from the directional bias of the put, but when stocks move down, volatility tends to move up as people get scared. And so I would get that added benefit of the volatility rising and making my put more expensive, at which I could sell it to other scared participants and realize a pretty handsome profit. So when volatility is low, I want to be a net long. I want to be net long premium, because that's just an edge that can play in my favor. And on the flip side, when volatility is high, I generally want to put on positions where I'm selling options. Okay, so if I'm let's say if I'm bullish on a stock and volatility is high, instead of buying a call, I'm not going to buy a call because those options are pretty expensive right now because volatility is high. Instead, to express my bullish position, maybe I'll just short a naked put, okay? Because I'm getting so much premium to sell that put. And if the stock goes higher, that put's going to expire worthless, and I'll keep all of that juicy premium. And I also will then have the added benefit of having a lot more room to be wrong. Because I sold a put for a lot of money, more than normal in a high volatility environment, if the stock that I'm bullish on confuses me and instead goes backwards and comes back down, well, I've got a lot of room to be wrong on that trade, and I like that, okay? Because we'll just keep hammering the Apple example. Apple's trading around 315 right now. If I sold a 300 strike put and I collected, I don't know, $5 for it, let's say, well, my break even on that trade would be 310, right? It's a 315 strike, but I collected $5 in premium. So as long as Apple stays above 310 at expiration, I'm going to make a little bit of money on that put. So it gives me a lot more room to be wrong. But anyway, we won't get into a deep dive there, but just wanted to point that out, that the volatility informs the decisions that we want to, the trades that we want to put on. Again, my slides are hanging. There we go. So going back to this chart, this graph that we saw here, I'm cherry picking, of course, because I have the benefit of hindsight, but let's say I'm right here and volatility is at the highest level it's been on this chart. Well, generally speaking, if I'm going to put a trade on this instrument, I want to be putting on trades that are short premium. So if I'm putting a directional trade on, let's say I'm bearish, okay, and volatility is very high, I might sell a call vertical. And what is a call vertical? I'll sell a slightly out of the money call and protect it with a further out of the money call that defines my risk. And maybe another sidebar here, I'm not going into a deep dive. This is not like an options 101 course that I'm doing right here. I guess I'm assuming that you know a little bit about options, but really I'm just trying to once again hammer home the thought that what's great about options trading is that it gives you options, okay? That's the takeaway here. We're not going to get into how to do all this stuff. We could do that another time, but I'm just trying to give you the sense that options give you a lot more plays, so to speak, to express your positions or express your opinions. So here, when the volatility is high, I want to be looking to sell premium. And maybe I don't have a directional bias at a time like this. Instead, and this is something I will frequently do, especially in indexes. I don't generally do this in individual stocks due to the gap risks that are involved in stocks, but in indices, you know, like SPY or XLF, that's the financial ETF, or XLU, that's the utilities ETF, things like that. When I see volatility high like that, or right here, for example, oftentimes I might look to put on a delta neutral spread where I'm selling an out of the money call and I'm selling an out of the money put, and hoping that the index just kind of stays in a range for a few weeks, and I could buy that spread back cheaper and pocket the difference. That's a trade I do a lot when volatility is high in an instrument. All right, so we're not, like I said, we're not going to go deep dives in any one of these strategies, but I'm just kind of listing some of them here, common trades that I will put on in different environments. So when I'm bullish and I see that volatility is low, again, volatility is the first thing I look at when I'm putting a trade on or considering putting a trade on. Volatility informs everything else. So once I have an opinion on a stock, whether it's bullish or bearish or neutral, right? If I think the market might go sideways, that's step one. Then step two, or maybe I should say that's step 1A, and then step 1B is where's the volatility? Okay, that's so important because the volatility informs which set of strategies I'm going to use. So if I'm bullish and volatility is low, I might look to buy long calls. I might look to buy long call vertical spreads, which I'll show you an example of in a minute, just to lower my cost. If it's a high vol environment, I might sell naked short puts. Or I might do some ratio spreads, a ratio spread being where I sell one, at the money call and use those proceeds to buy two further out of the money calls for a small credit. And that'll give me the ability to have the naked or the short call pay for the long calls. And then in that case, if the trade doesn't work out, at least I can walk away with a small credit. But if the stock takes off because I'm bullish, then I'm kind of getting a free ride on the long calls, which is nice. On the flip side, if I'm bearish and it's a low vol environment, I might buy long puts, or I might do a long straddle or strangle. That's a delta neutral play where you're just kind of betting on the fact that a bearish move may happen. But a little sidebar here, and when we've all experienced this recently, is in bear markets or in bear moves, when stocks are going down, the bounces can be vicious, and they are vicious. So a stock might be in a protracted downtrend, a downtrend that's been going on for a year, right? But within that downtrend, I can promise you there's going to be some vicious bounces where the stock bounces way higher than you think it should for a stock being in a bear trend. And it'll bounce high enough to make it really hard for people who are holding short positions to maintain that short position. That's a hallmark of bear markets and bearish moves in stocks. They're just really hard to hold on to. And so a lot of times if volatility is low and I'm bearish, I might put a straddle on or a strangle. A straddle basically is buying a call and a put at the same strike, okay? I do that because the volatility is so cheap. And yes, I'm bearish. I think the stock's going to go down and my long put will make money and the long call will just expire worthless. But there's a good chance that there could be I could be wrong, and there could be a vicious bounce. The stock could go way higher. And then, in fact, I'll make money on my call instead of the put, which is a nice consolation prize. So I do like to put on long straddles and strangles when I'm bearish on a stock, when the volatility is low. Now, I think I should throw a little caveat in there. Rarely do you find a situation where you are bearish and the volatility is low. Why? Well, I should say, in my experience, usually I'm relying on price action and technical analysis to get me bearish on a stock, right? So we're looking for trends. So if I'm bearish on a stock, in most cases, it's because the stock is already bearish. The stock is already in a trend that's going down. And if it's that obvious to me, then it's going to be that obvious to most market participants. And as such, people are going to be bidding up the cost of puts, bidding up protection, hedging their trades, and volatility tends to be high in stocks that are headed lower because people are already scared. So really, you don't get too many chances to put on a low vol bearish trade unless you have either, you're taking a bet that you see something that nobody else sees, right? Like maybe you've got some inside information or what you consider to be inside information. I'm not saying you should do anything illegal here, but let's just say you've got an interpretation of the data that is pretty unique and it's not being appreciated by the market, and you think a stock is about ready to surprise everybody and start moving down. Well, when those rare situations set up, that's a great time to be long puts or long straddles. And put calendar spreads is another trade that I like to put on too, and I have an example of that here I'll show in a minute, where it's a trade that benefits not only from getting the direction right, you're bearish, but also a expansion of volatility, which is what we're looking for. When volatility is low, we want volatility to rise, right? We want the cyclicality of volatility to work in our favor. And lastly, in high volatility, when I'm bearish right here, I don't like to just buy puts when I'm bearish in a high volatility environment because they're too expensive. They're very expensive. What I might do is buy an in-the-money put vertical spread, meaning I buy like a slightly in-the-money put and sell a further out of the money put against it to reduce the cost. That puts the edges a little bit more in my favor. Or I'll short call vertical spreads, which is a favorite move of mine. That's something I did a lot in February and March of this year. All right, let's move on. I just realized I only have about 15 minutes left here, and I'm actually going slower than I thought I would. I warned David that I might go quick, but maybe I underestimated. Okay, so I've got two trade examples here that could be instructional for those of you who are considering options trades, and just want to kind of work you through the process that I go through when putting trades on. So the first trade I'm going to talk about is in Mercado Libre. I don't know if I pronounced that right. My Spanish doesn't get much exercise these days. But Mercado Libre, ticker MELI, this is a stock that the research team at All Star Charts got pretty excited about recently. This chart is a little out of date now. This is just a chart that we shared at the time that we put the trade on. This was from a couple weeks ago. But as you can see on this chart, MELI major breakout above recent highs, and that got us bullish. Okay, the team here is very bullish on this stock, and we remain bullish. And so that is step 1A, right? We have an opinion. We think this stock is going higher. Research team thinks this stock is going to go head up towards 936. I think is what the price target was, 935, somewhere in that area. Okay, that's step 1A. What's the next step? Where's the vol? Okay, this is the actual volatility chart for Mercado Libre, MELI, when I was considering putting the trade on. And as you could see, just like many stocks in the universe in March and February, March, volatility went really, really high. But since the middle of March, it's dramatically receded. And at the time I was considering putting a trade on, here's where we were. Now, oops, go back. Now, again, I don't care about this value, the 4921. That's a meaningless number to me. I don't care about that number. What I do care about is that volatility is right here, and it's been as high as up here earlier in the year. So we're back in the lower end of the range for volatility in this stock for where it's been for a while. That's important because that means that the options are pretty cheap right now, relatively cheap. So how do I use that information? Well, that means I want to be a net buyer of options, okay? Because volatility is relatively cheap. That gives me an edge to get long options. But in this case, while volatility was cheap, the stock is not. Let's go back a couple slides. I mean, look at the price of this stock. This is this is almost an $800 stock when we considered putting this trade on. I think it was trading at like $790, I believe, when we finally put the trade on. That's a very expensive stock. So one of the great things with options is if a stock is expensive, well, you could lower the cost using options, and you could lower it even further by doing a spread. So to reduce my total cash outlay in the trade, I employed what's called a bull call spread. A bull call spread is a vertical spread where you buy one call and you sell a further out of the money call to reduce your net cost. So here's what the trade structure of the trade looked like at the time that we put the trade on. We bought September options, which gives us a few months for our thesis to play out. Got a lot of time for us to be right. And the stock was trading, as you can see here, it's hard to see the number, but the stock was trading around 790 at the time we put the trade on. So I could have bought just the straight 800 calls, right? I could have done that because in volatility terms, volatility was cheap. But here's the thing. Those options were, at that time, were being quoted at $88 per contract. And you got to multiply that by 100. So that's $8,800 it would have cost me to buy one call. Now, again, in volatility terms, that's cheap. But in hard dollar terms, in money in my account terms, $8,800 is a lot of money. And if the trade doesn't work out, that call could expire worthless and I could lose all of that premium. I wasn't comfortable risking that much on one call. I don't have a monster account, right? I don't want to risk $8,800 on one trade. That's way too much risk for me to take in one trade. So what I did in this case is I bought the 800 calls, but I shorted the 860 calls against it. And the 860 calls, remember the 800 calls were trading around $88. Well, the 860 calls were trading around $63. So at the end of the day, what I was able to do is I was able to buy the 800 calls, sell the 860 calls, and my net cost was right around 25 bucks. That is much more manageable. 25 bucks times 100 is $2,500. Still a lot to risk on one trade, depending on the size of your account, but a lot more palatable than $8,800 if I would have just bought the calls. So again, here's an example of options giving us options, right? I can still express a bullish trade. I can still ride a bullish move in this stock, but I've limited my risk. I've limited the capital outlay, and I've gotten it down to a level that is comfortable for me. And I know the net cost of this trade cost me $2,500. I know that worst case scenario, if Mercado Libre were to crash and go to zero, the most I could lose in this scenario down here is $2,500. I don't want to lose $2,500, but I'm comfortable losing $2,500. And in this case, for me, I have a mental stop loss in order in place where if this spread loses 50% of its value, I'll just close it down. Trade's not working. I don't want to risk anymore if I can help it, right? But I'm comfortable with the maximum amount of risk, and that's okay. All right, so that's one example, a bullish example of using options to define my risk, participate in a trade, and do so at lower cost. The next trade, and this will be the last example I'll go through, this is a recent trade that we put on, is a trade in Amazon. Now, my research team at All Star Charts put together a piece, and they were talking about how Amazon and the S&P 500 were showing signs of potentially stalling and potentially running out of gas on the upside. Okay, and here was J.C. Peretz is my partner at All Star Charts. What he wrote in the research piece is that the price on Amazon cannot hold above recent highs. Relative strength put in lower highs, and momentum diverged negatively versus its February highs. Now, this is all technical mumbo jumbo for many of you, I'm sure. But for those of us who follow technical analysis, these were some very important clues that said to us, like, hey, maybe now is the time to put on a bearish trade in Amazon. So, and I apologize, I did not put in a volatility chart for Amazon, and I should have. My apology on that. But once we decided that we wanted to be bearish in Amazon, obviously that's step 1A, and then step 1B is where is the volatility? And I did a quick scan of the volatility, and it looked very much like the volatility in MELI that we showed before, Mercado Libre. Volatility is way off where it has been for the past year. Volatility has mean reverted back to being cheap, relatively cheap in Amazon. And this is one of those cases where we're bearish Amazon, volatility is cheap. These opportunities don't come along very often. I'm going to take advantage of that. And the trade that I decided to do was a put calendar spread. So at the time we put the trade on, Amazon was trading around 23.50. It's unfortunately it's since higher and not looking so good. This trade may not work out, and that's okay. I defined my risk in this trade. And this is the trade that we did when we were bearish. We're still bearish, but that may change as the market's screaming higher. But this is the trade that we are in currently right now. It's a put calendar spread at the 2000 strike. So what we did is we shorted a June 2000 put and purchased a July 2000 put. What this accomplishes for us is really we want to be long the 1000 or the July put, because that gives us a little bit more time to be right. But we're helping reduce the cost of that July put by selling the June 2000 put against it. And if I recall, let me bring up I got it on my other computer here. I think we paid about $20 for this trade. Okay, so $2,000, right? $20 times 100. If you're doing one contract, that's $2,000. So this is a defined risk trade. Amazon could scream up to 3,000, or it could crash to 1,000. The most I could lose in this trade is the debit that I paid to put the trade on, which in this case was around $2,000. Okay, hopefully it doesn't come to that. The play here is I like this trade because what's going to happen is if we got the trade right, if we nailed it, and Amazon does roll over and start heading down, not only will we benefit from getting the direction right, okay, at least down to here, we'll benefit from getting the direction right, but we'll also benefit from the rise in volatility. And the July put that we are long has more time to expiration than the June put, and therefore volatility will raise the value of the long put faster than it will raise the value of the June put. And therefore, that'll give us more juice and make the spread worth more money. So this trade benefits from direction. It benefits from a rise in volatility. We could put this trade on now because volatility, relatively speaking, is low in Amazon. Okay, so we can win two ways in this trade. We can get the direction right, and the volatility rises. That's a great thing. And hey, here's the kicker. Again, options give you options. Let's say Amazon starts trading down, but it takes its sweet time. Okay, it's not ready to move yet, but it starts moving down this way. But we get into June expiration. These options expire the third week of June. If we're still above 2,000, those short puts are going to expire worthless. But I still will have the long July 2000 puts for an extra month. And if Amazon were to crack below 2,000, now we're sitting on just a straight long put with theoretically unlimited upside above. Although obviously Amazon can't go below zero. I don't think that's possible in this scenario. But that leaves us with a long put that we're riding that costs us significantly less because we had originally shorted the June put against it to lower our cost. So that is a trade that we've got on, and that's just these are just a couple examples of how we come up with a trade opinion and use volatility to help inform us on the trade that we want to make. So my time is just about up here. So I just want to throw this up here for those who are interested in learning more about All-Star Charts and what we do. If you're interested in leveraging technical analysis to get into smarter options trades, that's what we do, right? I'm biased, of course, but I think All-Star Charts is one of the best in class is when it comes to technical analysis research. And we used their technical analysis research to leverage into smart options trades. We take a lot of directional bets. We do it with a lot of defined risk trades. We also do, delta neutral premium selling trades when the technical analysis indicates that that's the right move. But if you'd like to try it out, we offer a 30-day risk-free trial. Just go ahead and send us an email. The email address there at the bottom, info@allstarcharts.com. And in the subject line, put "I want options," and we'll get you hooked up to try it out. Again, it's 30 days risk-free. So if you're not happy, or if it's not for you, or if what we do doesn't jive with your idea of risk or workflow, you can cancel within 30 days and no risk on your part. So give us an email, info@allstarcharts.com. Type in the subject, "I want options." That's one way to get started. And if you ever want to reach out to me, I'm Chicago Sean on Twitter. You see my Twitter handle right there, @ChicagoSean. Reach out anytime. I'm happy to engage with you on Twitter. Please do. I love talking options and talking trading, talking markets. That's what I do on Twitter. So reach out, @ChicagoSean, and then there's that email address again, info@allstarcharts.com, if you want to learn more about what we do at All-Star Options with All-Star Charts. And with that, Anka, David, I believe I'm done.